Welcome to Ambani Kichai by Anirudh Jain. I don't think people understand the true impact of financial crises in developing economies. Financial crises are a recurring nightmare for developing economies. These crises inflict widespread suffering, wiping out savings, devastating businesses, and plunging millions into poverty. The human cost of these economic shocks is immeasurable, often leading to social unrest and political instability. Understanding the causes and consequences of financial crises is paramount for building resilience and ensuring sustainable development. The history of developing economies is sadly replete with examples of such crises. From the Latin American debt crisis of the 1980s to the Asian financial crisis of 1997 to 98, these events leave lasting scars on national economies and the global financial system. The frequency and severity of these crises highlight the inherent vulnerabilities of developing economies and the limitations of traditional economic models in predicting and mitigating them. These crises are not merely economic events, they represent a complex interplay of economic vulnerabilities, political decisions, and social inequalities. The challenge for policymakers and economists is to move beyond simplistic explanations and develop a nuanced understanding of these events to prevent future catastrophes. Anatomy of a crisis. Unpacking the Mexican, Asian, and European examples. To understand financial crises, examine specific examples. The Mexican peso crisis, the Asian financial crisis, and the European sovereign debt crisis offer valuable insights. The Mexican crisis exposed the dangers of short-term foreign capital and fixed exchange rates. The Asian crisis showed how rapid capital flows could reverse, leading to contagion. The European crisis highlighted the interconnectedness of global markets and currency union risks. These crises share common threads: rapid risk buildup, triggering events, and loss of investor confidence. They underscore the need for preemptive regulatory measures. The illusion of prediction: why models often fail. Despite advancements, predicting financial crises remains elusive. The complexity of markets and human behavior makes forecasting difficult. Traditional models struggle with irrational exuberance and sudden shifts. The 2008 crisis exposed the limitations of mainstream economic thinking. Economists failed to anticipate the crisis, highlighting flaws in rational market assumptions. Predicting crises underscores the need for humility in economic forecasting. Section 4. Challenging the Orthodoxy, Grable's critique of neoclassical assumptions. Economist Eileen Grable has been a vocal critic of neoclassical economic assumptions and their role in exacerbating financial crises. Her work challenges the conventional wisdom that underpins much of mainstream economic thinking, particularly the belief in efficient markets, rational expectations, and the self-regulating nature of capitalism. Grable argues that the neoclassical framework, with its emphasis on market fundamentalism and deregulation, fails to account for the inherent instability of financial markets and the potential for irrational behavior. She contends that the blind faith in market forces, often promoted by international financial institutions, has led to policies that prioritize financial liberalization over regulation, increasing the vulnerability of developing economies to external shocks. Grable's critique highlights the need for a paradigm shift in economic thinking, one that recognizes the limitations of neoclassical assumptions and incorporates insights from heterodox schools of thought, such as post-Keynesian economics. This alternative perspective offers a more realistic understanding of financial markets, emphasizing the role of uncertainty, investor psychology, and the potential for market failures. Section 5. Beyond prediction. A post-Keynesian perspective on financial instability. Post-Keynesian economics offers a valuable alternative to the neoclassical orthodoxy, providing a framework for understanding financial crises that emphasizes uncertainty, investor psychology, and the role of credit and debt in driving economic fluctuations. Unlike neoclassical models that assume rational expectations and market equilibrium, post-Keynesian economics recognizes the inherent instability of financial markets and the potential for self-fulfilling prophecies. From a post-Keynesian perspective, financial crises are not anomalies or exogenous shocks. They are an inherent feature of capitalist economies, driven by the interaction of real economic factors and speculative behavior. The emphasis on uncertainty and the importance of investor sentiment in shaping market outcomes provide a more nuanced understanding of financial instability than traditional models that rely on rational expectations and efficient market hypotheses. By acknowledging the limitations of prediction and the importance of regulatory intervention, the post-Keynesian perspective offers a more pragmatic and potentially effective approach to mitigating the devastating consequences of financial crises, particularly in vulnerable developing economies. Section 6. The human factor, investor behavior and market contagion. Investor behavior often transforms vulnerability into full-blown panic. Herd mentality leads to asset bubbles and market crashes. Irrational exuberance and panic selling amplify market fluctuations. Contagion spreads financial distress rapidly across countries. Understanding investor psychology and market contagion is crucial for policy responses. Pause 2S. Section 7. The role of technology in financial markets. As we delve deeper into the complexities of financial crises, it's essential to acknowledge the transformative role of technology in shaping modern markets. From high-frequency trading algorithms to blockchain technology, digital innovations have both mitigated and exacerbated market volatility. High-frequency trading, for instance, allows for rapid transactions that can stabilize markets but also contribute to flash crashes. Blockchain technology promises transparency and security but remains susceptible to speculative bubbles. Moreover, the rise of fintech platforms has democratized investment opportunities, enabling retail investors to participate in markets like never before. Yet, this democratization brings its own set of challenges, including increased susceptibility to market hype and misinformation. Understanding the dual-edged nature of technology in financial markets is crucial for devising effective regulatory frameworks and ensuring market stability. Pause 1S. And remember, understanding the past is the key to navigating the future. Thanks for watching Ambani Ki Chai. If you found this video insightful, please like, share, comment, and subscribe for more in-depth analysis. Stay curious, stay informed, and let's keep exploring the financial universe together. See you next time.